Welcome to The Explainer. Today, we're going to break down a concept that is absolutely fundamental to understanding the financial health of any business, the asset conversion cycle. So let's start with a situation that every single commercial banker knows. A business comes to you asking for a loan. Now, they'll give you a reason, of course, but what's the real story? What's the true driver behind that request? Getting to that underlying cause is the absolute key to smart, effective lending. To figure out that true cause, you first have to understand how a business actually works. You can think of it as being powered by two fundamental repeating cycles. On one hand, you've got the short-term, day-to-day engine. That's the business activity cycle. It's that constant churn of buying materials, making things, and selling them. Then you've got the long-term foundational engine, the capital investment cycle. This is about buying the big stuff, the factory, the machinery, the assets that make all that daily churn possible in the first place. Okay, so you put these two cycles together, the daily churn and the long-term foundation, and what do you get? You get the whole shebang, the asset conversion cycle. This is the master process that describes the entire journey of how a company turns everything it owns back into cash. All right, to really get this, let's follow the money. We're going to trace the journey of a single dollar as it moves right through the heart of a business's operation. So a dollar leaves the bank to buy some raw materials. Those materials get turned into finished goods. Those goods are then sold, but usually on credit, which just creates a promise of payment. And then finally, that promise turns back into a real dollar in the bank. Now, this cash-to-cash journey might seem simple, but the time it all takes, that lag in the flow, that's where the complexity and the need for financing really kicks in. And those delays we just talked about, they aren't just minor details. There's significant gaps in the timeline. And it's right inside these gaps that the need to borrow money is actually born. First up, you have the holding period. So what's that? It's the length of time between when a company pays for its inventory and when it actually sells that inventory. For every single day a product is just sitting there on a shelf or in a warehouse, the cash that was used to make it, it's completely frozen. It's stuck. Then, even after the sale is made, the problem's not over. The collection period begins. I mean, the company made a sale, which looks fantastic on the income statement, but they are still waiting for the actual cash to show up. The invoice is out there, but the bank account is still empty. Now, there is one thing that helps the company out a little bit: the payment period. This is the credit the company gets from its own suppliers. The pay us in 30 days kind of deal. This definitely helps, but it is rarely, if ever, long enough to cover both the time cash is frozen in inventory and the time it's waiting to be collected. So, here's the bottom line. You take the time that cash is tied up in inventory, you add the time it's stuck waiting for customers to pay, and then you subtract the bit of breathing room you get from your own suppliers. What's left over? That timing difference, that gap, is the true fundamental reason a perfectly healthy business needs a loan. And this financing gap, it becomes even more critical when a company is doing well and growing. In fact, and I know this sounds totally backward, but growth is very often the thing that makes the need to borrow so incredibly intense. Think about a business with seasonal growth, say a toy store stocking up for the holidays. That creates a temporary need for more cash to fund all that extra inventory. Those assets will turn back into cash once the season's over. But a business with sustained long-term growth, it has a permanent need for a bigger base of inventory and receivables, an ongoing requirement that doesn't just go away. This all leads to a huge paradox that every lender has to understand. Sales growth usually requires more cash than it generates. Why? Because the company has to spend money today on more materials, more staff, and more inventory to support sales that it might not get paid for until weeks or months from tomorrow. Rapid growth literally consumes cash. So what does this all mean for that loan you're looking at? Well, it leads us directly to the single most important rule there is for structuring credit. And the rule is this: you must match the duration of the financing to the duration of the borrowing need that you've just diagnosed. And in practice, it's pretty straightforward. That temporary buildup of assets for the holiday season, that's a classic short-term need. You should finance it with short-term funds, like a revolving line of credit that gets paid right back down after the season. But that permanent increase in assets needed to support sustained growth, that's a long-term need, and it requires long-term financing because that cash is now a permanent part of the company's core operations.
So the next time a business comes to you for a loan, you can see beyond just the surface-level request. You can ask the real question. Which part of the asset conversion cycle is actually driving this need? Is this a temporary gap, or is it a permanent one? Answering that question, well, that's how you stop just providing a loan and start structuring a real solution.